Dividend investors have new competition, and that's cash. I do like this a lot. Now, just let me side note for a quick. Some guy said, should I take my money out of the banks? No. I mean, do whatever you got to do. I don't care. What are you going to do? Put in a fireproof box? No, man. Come on. Inevitability doesn't mean we have nothing. A crash doesn't mean you have nothing. The Roman Empire crashed. Rome is still here, my friends. Right? The Ottoman Empire crashed. Turkey is still here. All right. Now, I don't know about Assyrians. They might not be around anymore. But you see what I'm saying? It's, come on. The issue that you have to contend with isn't to just say, oh my goodness, things are bad, thus I'm going to do this crazy thing, which is pull everything out of my accounts. The issue is just to recognize the risk for what it is and to do and move accordingly. And of course, the prudent thing you should do is pay off your debt without question. With that said, it's still hard to turn away from nice CD rates. Look, dudes, you might not remember what happened to Argentina. I think the Argentinian depositors at banks took like a 20% haircut to basically prop up the currency. I want to say the 80s or 90s. I think it was the 90s. I can't remember. But basically, just overnight, the 20% of their assets were gone. That's Argentina. That's, I hate to say the worst case scenario because they're a lot worse. But that's not likely to happen here, right? At least not anytime soon. We're talking generations from that likelihood. It's just not likely to happen like that, if that makes sense. Now, Argentina isn't the United States. Wait a second. Oh, of the in the land of the blind, the one-eyed person is still king, if that makes sense. So right now, we are in a land of the blind, that's for sure. Everything looks bad to me. I'm just telling you right now. The one thing that still looks better than everything else is bank deposits and certificates, without question. It's an, I don't know how to say this. That's not the right word. It looks good to me for the next couple of years, the way the interest rates are. That's why I just said in a video the other day. It's never been a better time to be a conservative investor in decades. So check this out. Dividend stocks have new competition, cash. Just 34 stocks in the S&P 500 have a dividend yield above that of the 6-month Treasury bill. All right, so I want to point out something. Remember, the dividend yield is based on the actual dividend per share plus the price. So this could change very quickly. Just 34 stocks have a dividend yield above that. If the prices go down, that will change rapidly. I think I can find. Hold on a second. I'll show you a lot of this article I have from CNN Money from 2007. Why banks beat bonds? July 24th, 2007. I was still a broker at that point. Would be great if you could find that ideal blend, an investment that combined the cozy security of government bonds with double-digit returns investors expect from stocks. That seems like a pipe dream in a world where 10-year treasuries yield 5% and equity sell at a premium price that augur a dim future. But this ideal investment exists, and believe it or not, it's called bank stock. Hold that yawn. Bank stocks offer a sterling array of qualities right now. They pay huge dividends. I gotta see what my thing says. They pay huge dividends approaching 5% that are bound to keep rising. They're incredibly cheap and their prospects for growth are incredibly strong. He talks about Citigroup, Wachovia, Bank of America. It gets better. And the banks, of course, dividends are taxed at QDI as opposed to ordinary income from bonds. Dividends are likely to keep growing. Bank of America is expected to raise its payout by 11%. Sounds too good to be true, as the bank bond yields on dividends were higher than bonds. So you could buy the bank stock with a dividend or buy the bond. And the yields were higher than the other bonds. And it got taxed better. And they grow. Double-digit returns. Who could go wrong? Let's see. Sounds too good to be true, and that's what the market thinks. And this is why stocks are cheap. But this is a case where market seems to be wrong. Some analyst says investors fear a credit meltdown because of the woes in the subprime market. And then she goes on to say, she's with Morgan Stanley. That's making the market far too pessimistic about bank stocks. None of these banks have troubling exposure to subprime credit since they sell almost all such loans to institutional investors. All right, let's see what this happens, lady. Still with Morgan Stanley. Jeez, man. Let's see. We got Let's see if we can find her. Betsy Graysick echoed what sentiment? We believe that the sell-off was overdone as large banks have a lot more liquidity than smaller banks. They're more diversified with broader business models, blah, blah, blah. All right, and Betsy Graysick echoed that sentiment, saying in a note Friday morning that the issues appear highly idiosyncratic and should not be viewed as a read across to other banks we cover. Okay, yes, funding is, okay, whatever. So remember, this is the same lady who right there in 2007 was saying, not one of these banks has troubling exposure to subprime credit since they sell all their loans to institutional investors. Surprisingly, the fastest grower was Citibank. All right. I guess people forget. I don't know. I don't forget, dude. I don't forgive and I don't forget. Oh, I do forgive because if Jesus can forgive me, the good Lord above, God himself forgives me, I need to forgive too. But the issue is I don't forget. I remember like this was yesterday. And so now we got the bank Wall Street Journal. I got to read it a little bit here from my phone because I don't have a subscription. For some reason, I'm able to read it on my phone, but not on my computer. It's kind of weird. So let's see here what the Wall Street Journal says about dividend stocks have new competition, cash. All right. So remember, that's what I was going to say. So when yields go up, that's because the price of the stock went down by and large. It's not typically because the dividend actually went up. They pay a little bit more, but that doesn't usually make the yields go up. It's because the price of the stock goes down. So while you're waiting for the stock to go down to get a higher dividend yield, the cash looks great. Oh man, yeah, now I can't read it. Oh man, I was able to read it. Now I can't. I just tell you, man, the opportunity. Well, let me just real quick. So stocks used to be the only game in town for investors chasing robust returns. That's hardly the case anymore. Soaring inflation has put government bond yields to their highest levels in more than a decade. That, coupled with the soggy stock market, has led to a steady decline in the number of stocks that offer comparatively high dividend yields. There were just 34 stocks in the S&P with a dividend yield above the 6 months Treasury bill. Yeah, I 100%. I do not disagree with that in the least. And if we're looking at bank CDs as well, let's just let's go back one sec. Bankrate.com. Let's go to let's see, that's the minimum. We'll go to 2 year, to 5 years. There we go. Let's see what we got here. 2 to 5. What's going on, man? I don't want that great offer. Just give me the freaking. Here we go. All right. So we got American First Credit Union 2-year term 4.75. So basically, while you're waiting for the price of stocks to go down, and they might not, I don't know, but you're getting 4.5%. Look at that. GTE Financial Credit Union, 4.5%. 4.5% for 5. Okay, gotcha. BMO Harris Bank, yeah. First Internet Bank of Indiana, yeah. Pentagon Federal, look at that too. Anyway, so you're getting 4.5% while you're waiting for the prices of stocks to go down. And if they don't go down, you still got 4.5%, man. All right, you know what I'm saying? You're still getting a decent rate of return while you're waiting. Should you sell your stocks? You got to do what you got to do. I'm just saying, if I'm sitting there in cash, I'm like, if I'm sitting there thinking I need a dividend, I'm like, man, those bonds look pretty good to me. And bonds in this case are CDs, without question. Money markets look good too. The money markets changed too much. In fact, I think the 10-year Treasury is down to 3.4. I saw this morning. Let's see what it's doing right now. And that's the thing with money market accounts, is they can change on a dime. Whereas you lock in a CD, the 10-year Treasury now, it's down 6.71% the yield today. Look at that, dude. Crazy. Look at that. Nuts. Anyway, so that's see, my thing doesn't work on it. Weird. Anyway, point being is, if you can lock in for 2 to 5 years at 4.5 while you're waiting for stocks to fall, you're not sacrificing a lot of the dividend yield. That's just a fact. And if stocks don't fall and they go up, all right, you missed out on that. But is that the worst thing that ever happened, especially about to retire? No, I don't think so. All right, love your thoughts. We'll see you.